CEO at HousingWire, and we are here for a pretty legendary conversation. This may be the first time, at least my first time, bringing together leaders from the 3 nationwide consumer reporting agencies to talk about what's changing in data in the mortgage process. Joel, Michelle, Satyan, thank you so much for joining us today. So, Joel, I want to kick off with you with kind of your view on why data is so important in today's mortgage ecosystem, and how you're thinking about the landscape that is just the talk of the town.
Well, first I want to say very much thank you so much, Satyan and Michelle, for joining us. I think it's important for everybody to know we are vicious competitors. I mean, outside of this time right here, we're going to fight to earn our business with each and every customer, and we all come to the table with our unique offerings and our unique differentiators. So that's the first thing I want people to realize. But more important, all of us are here today because we actually stand united that more data is better for the consumer. And that starts with all 3 credit reports. Yep. And then that expands out on all the differentiated things that all 3 of our organizations are doing to bring to the industry with the single objective of how do we help more people qualify for the loan. That's what it's really about, where there's so much conversation about how do we reduce data. That's how you eliminate people. We're looking at an inclusive approach of how do we get more people qualified today. So I think we all share that, and the fact that we're all sitting here together is representative of that united goal.
Michelle, do you feel the same way? Vicious competitors?
Well, yeah, I can't agree more on that. I mean, it's all day, every day. And I totally agree also. Our mission is financial inclusion for all. And so we spend all day, every day, not just competing with these guys, but also working really hard to make sure that we can fairly represent all consumers and give everybody the chance to home ownership if that's what they want.
All right, Satyan, on the topic of vicious competition, it's been disclosed by each of you that there are major differences between your credit files and the data you report.
I think one important fact when it comes to the 3 national bureaus is we don't see each other's file, which makes that an even harder competitive landscape, right? I cannot inspect Michelle's file or Joel's file. So I really have to work with my teams to do what we think is the best thing to add to our bureau data. And it's something that, for those that aren't aware, we have, I can speak to myself, me and my team are the face of the mortgage business and also the auto business, but we have large amounts of people whose job is every day in and day out, to source more information, more data on the file. And one thing I want to add here is the file is just becoming more and more diverse. Like, we can talk about this a little bit more, but there are so many new, different, unique financial lending products that I think the world right now is as differentiated as a file as we've ever seen.
What's an example of like the new data capabilities or features of the file?
Sure. So for one example would be the buy now, pay later lending product. Okay. So the Affirms of the world. We work through CDI and industry organizations to talk about how to get something standard on that on the file. But at the same time, it's really up to the furnishers to decide when, how much, and to whom they furnish. And so again, we compete very ferociously about getting getting as much data as we can on our reports.
The goal is to give as much representation to consumers as we can. And so whether that's through rental payment history, whether it's through how consumers manage their cash flow, whether it's through alternative financial services, whether they be short-term loans or things like buy now, pay later, like Satyan was just talking about, I agree. Like, the files are more diverse now probably than they've ever been.
I think about it from overall contributors. If you think about 5-10 years ago, the number of people contributing data to a credit file today has gone up 3x. Yeah. And it's all of the things that my peers here are talking about. It's different type of contributors. And so you have not only the difference in financial contributors, but then you also have the additional data around, are they paying rent, like Michelle said, or do they have utility information that we can add? Because the new scores will take that into account and help improve that look of the customer. And it all comes down to the data. Without the data, you don't have a score. And without a score, you don't go anywhere in the process.
I'll jump in and say, I can speak for TransUnion. I think this exists with all the bureaus. It's Michelle's comment earlier. It's about getting access to credit, access to homes. TransUnion works a lot on that consumer education, free credit scores. Download our app, right? to be able to really understand what a consumer can do to change and what changes they can make to make themselves mortgage eligible, right? And so there's a lot of education there that consumers do need to continue to build on. And again, with this proliferation of different products, you think about a younger generation and maybe their first experience with credit is, an Affirm loan, right? To understand what does that mean? What does that mean to go apply for a credit card? There's a lot of education that consumers need, but at the end of the day, the credit score in mortgage is I just think of that as like the doorknob to get in. It's just the front door. It's actually the data that we've been talking about that is used for the underwriting. The GSEs don't actually use a score in their underwriting. All they use is the data and the trended data that was pioneered about a decade ago, right? Which is much more data that's used in the traditional score today. So it's all about that data that's in the score. And again, the data is different across the bureaus.
It's not just the underlying data. It's the innovation in the technology, in the security, in the consumer support, and how we answer questions for consumers, how we educate consumers, the tools that we give them, the places that we go to be able to communicate with them in a way that's meaningful.
It feels like more data is always something that people want. But one of the trends and the talking points I've heard is the potential move from tri-merge to a bi-merge, or even situations where a single report could be the solution for lenders. So that's kind of the move to less data. I have a feeling that's something lenders are pretty curious about.
I think it's a very slippery slope. And so I'll actually start in non-mortgage. There's a lot of big lenders in today's world that pull 3 credit files or 2 credit files in the auto space or even the credit card space because they believe that there's differences, and they want to see those differences because they believe it gives them a competitive edge in making better decisions and pricing their products more aggressively. So that is someone that has total choice. They could go with no credit score, no credit file, and they're choosing to buy 3. And we're seeing that more and more in the industry. When it comes to mortgage, it really comes to the lost applications. The whole drive is an economic drive.
Yeah.
If we're talking about what is the best way to get consumers into homes and to qualify more consumers, it is more data. And I haven't heard anybody really give a solid argument as why that's not true. All of the arguments I've heard have been very much financially based, which I respect. And I think that all of us are working together with the different options to say, how do we help up front on the shopping behavior to control cost a little bit more, but we maintain that very proven safety and soundness on the back end so that the consumer gets the best price possible and that the American taxpayer is backing good quality loans.
And it all ties back to, for a score that scores more people, that takes account for all of this data that we just talked about. And so I think all of us understand that kind of financial conversation. One of the things, and again, this came up as well yesterday from Stan from Freedom Mortgage, thought he made a great point of the U.S. housing system is truly the envy of the world, right? It's kind of a remarkable way to match capital with people looking to buy a home and getting to a home in a very efficient and a very safe way, right? In a safe way to get people now, what is, the average mortgage is well over $400,000. You're getting up to $1 million mortgages, to pay maybe $10, $15 more for credit data to keep that system going seems like it's worth it.
Yeah, I would like to comment, though, building on this. In today's world, the lender has the ability, the choice, to have one credit bureau, to bring that in and to start the underwriting process. They're not required to have all 3 till later in the process. But what we see from many lenders is they've had that bad experience for a borrower that they got closer to close, got the other credit scores, and they had to go back to that borrower and change the rate. And that's a bad experience for the borrower. It's a bad experience for the lender, and that sometimes results in a lost loan. So we see people voluntarily saying, as soon as I know somebody qualifies and they show me any sign I'm going to move forward, they want to make sure they have all 3 credit bureaus. And that is because the loss of a loan is so much detrimental compared to the cost of getting data to do the loan right. And it also reiterates that they know there's enough variation between our different credit bureaus that it has a high potential of changing when it goes to that final pricing sheet. And so there's choice today, there's options today, and we see people choosing with their pocketbook to buy more data sooner to make sure that the experience for their customer is that lender closes that loan.
I would say one thing, maybe adding on to what Joel said, is that the consumer experience is really important on the consumer having that certainty and again, getting credit for all of what they've done in their credit file or in their relationship to credit. There's been conversations about other lending lines. Again, Joel said very rightfully so that in other lending lines, multiple reports are used. Also, those are those lending lines that consume this alternative data way more than mortgage does. So it's good to see mortgage moving in that direction. But my point here is that typically a borrower and even their broker or their loan officer may not know exactly right up front which loan product is best for them. It could be a GSE loan, it could be a non-QM loan, it could be a VA loan, right? And I think, again, to be able to cast the net as widely as possible to get the consumer in the right product, taking a look at all three bureaus and really using a trended score like VantageScore is the best answer to get the best option from the consumer.
That's right.
The other piece I would put on that around the three bureaus and that is if we go to one, eventually, like in any area, the models are going to change a little bit. So if you know that the broker is picking the highest score, or you believe that, and you're seeing a 730, you probably eventually will see some of the pricing price that more like a 710 or a 705 because they have to take into account what they're not seeing. So the absence of data punishes the consumer from a pricing perspective. And I think that's one of the risks that we really haven't contemplated. But I will tell you, if you listen to enough of the panels, and there's been a lot of them in the last 6 months on this topic, a lot of our leading lenders are out there sharing that information. They truly want to get the best loan for the customer. And so there's a decent chance they're still going to buy all three bureaus. It's just they're going to put the best one forward. So then the overall ecosystem will have to adapt somewhat to that approach.
Michelle, can you kick us off with one of the biggest misperceptions that you're hearing here at MBA Annual or you hear from clients and interactions that you'd like to set the record straight on or bring clarity to?
I mean, I think Joel started off this session with the biggest one, which is that the bureaus don't compete or that there's not innovation happening within data or the credit bureau industry. Because like we said, mortgage is the only space that requires three bureaus to be pulled. We've been competing on that underlying data for decades, innovating, building on top of it, trying to represent the consumer as completely as we can. And so for me, that's the biggest misperception I keep hearing over and over again at this conference.
You know, I think you guys hit the main ones on the point. I did hear an individual stated that three credit bureaus is not good for the consumer. And I don't believe that in any way. I think that is a misconception, and I think that's the spirit of the conversation, that more data is better.
What do you think that person's perception was?
I think it was purely financial.
Financial pricing.
Maybe we can save $30 or $40 on that closed loan, which all of us know is such a small drop. I mean, it's less than a percent and a half of the total closing cost. To secure a loan in the most sound housing market in the world seems a little ludicrous at times that we're spending this much energy talking about it. But I'm glad we are. I think, you started this conversation talking a little bit about education and how are we doing that. It's what's become really obvious in the last couple of months is the vast need for education, not only for the consumer, but even our customers.
So on customers, and this is going to be the actual last question, but as we approach a period with lender choice and VantageScore, what do lenders need to do to get prepared? And what moves they need to be making today to prepare for 2026? That seems to be like the head scratcher I do hear pretty often. Michelle, please take us off and close us out.
I think separately, all three of us have come to the table and said, please, we will give you VantageScore right now so that you can evaluate it in actual underwriting decisions and know how it will play out in your portfolio and in the real decisions you're making over time. The GSEs are going to come out with their guidelines for it here soon, and then you'll know how you could make decisions using it. Take the score.
As Michelle said, we've all made it available. I know that Fannie is starting to add it on the back end in the MBS pretty soon here. So I just think eyes on the score start to develop that Rosetta Stone with it, an alternative to the score that's been in market for 30 years.
Okay.
And I would just wrap up. I think they've hit it on the nose. So I want to wrap up by saying thank you, Clayton, for helping make this happen.
I'm just proud we had a civilized conversation with three fierce competitors. Joel, Michelle, Satyan, thank you so much.
Thank you.